Welcome to week 3 of our multifamily masterclass. We're going to go tonight into some more technical details, metrics, things you need to know for underwriting and what some of the financial terms are and how they're relevant to looking at deals. I'm also going to give you some ranges and some guidelines on what you should see when you're looking at these and maybe some things that are some red flags. So we're going to get right into it. Let me share my screen here. And all right, let me put this in PowerPoint mode. Okay, everyone should be able to see the screen now. So once again, this is week 3 of our 5-week. It's planned for 5 weeks. We might have an extra session, but I'm going to try to fit everything into 5 weeks. First of all, a little bit of housekeeping, our disclaimer, this presentation and documents are for educational purposes only. Nothing in this presentation contains legal, tax, or financial advice. Investors should consult their own professionals to get that type of advice. Investments have risk. Understand the risk profile before investing. I can't guarantee investment results or outcomes related to real estate investing. This document contains the best information that I have at the time. All the sources are believed to be reliable, but I can't guarantee they are, or I can't guarantee that information that's in this won't change in the future. If there's financial projections in the document, we believe them to be reasonable, but they're based on assumptions, hypotheticals, and estimates. And nothing in this document has been reviewed or approved by the Securities Exchange Commission, which is the regulatory body that I work under as a capital raiser. Okay, what we're going to cover for week 3 is going to be key financial terms and formulas. This is going to be just the basics, the most important terms. And as I go through these, I'm going to go through them in what I feel is kind of the order of importance. And it's going to be the reverse of what a lot of people look at, but I look at things a little bit different. And so it's going to be a little bit different. So keep in mind, I'm kind of going in reverse order from what I think is the most important to the least important, or at least the most overrated of the terms. Net operating income, we're going to talk about that a lot from the beginning. Net operating income is the most important metric in any type of commercial real estate. It's what differentiates commercial real estate from residential. And so if you're trying to figure out the difference of what commercial real estate or multifamily and going out and buying single family rentals, net operating income is the secret. It is the secret that is the difference. It's going to be the most important metric, as I mentioned. We're going to talk about forced appreciation. How do we force appreciation? What is forced appreciation? Why can you do a forced appreciation on a property that's a commercial or multifamily, and you can't really do it on residential? We'll talk about the differences there and why it's important. We're going to talk about interest rates. Everyone always wants to know where interest rates are going. We're going to talk about the principle of not being able to tell and the best way to be sure to lock in interest rates that we have and make sure that we're going to have deals that cash flow over the life of the investment, and how interest rates are going to affect property values. And that's of interest to everyone that's been paying attention for the last few years. Net operating income. So this is the most important metric in commercial real estate. When you're valuing a property, it's the first thing anybody looks at. Whether you're buying a property, whether you're getting a loan, you're underwriting a deal, everyone looks at net operating income. So what is net operating income? It's a metric used to assess the profitability of an income-producing property. Okay, very simple. And it's a very simple formula. It's the total annual income of the property, rents, extra income, anything that is a plus that brings income into the property, the total annual income. And we usually within NOI are talking about annual income minus the total annual expenses. So that could be maintenance, repairs. It includes taxes and insurance. So it includes those two big ones that are uncontrollables. It does not include the mortgage payment or the debt payment or any kind of debt service payments you have. So if you have a property with no debt on it, the NOI is the exact same as a property with debt on it. You don't take the debt out of the NOI. So interest payments, mortgage payments are not included. So very simple, annual income minus annual expenses. Occasionally you will see on some T12s, which is like a profit and loss statement for multifamily. You'll see at the bottom, they're taking the mortgage payments out, and every month they're showing like a net cash flow or net NOI for the month. That's a little bit unusual and it's kind of confusing, but when you hear NOI, think annual income total minus annual expenses. Okay, like I said before, excludes payments on debt, principal, and interest. It also excludes income taxes. If you're in a state that has a state income tax, some states, not Texas, have income taxes on some real estate projects. I think California does. I think Colorado does. You got to file a state income tax. Doesn't include that, and it doesn't include depreciation. Depreciation is not an actual expense. It's a magical thing where the government actually gives you a deduction where they think the value of the property is going down when actually it's going up. So depreciation is wonderful. It's not included in there. So just think no debt payments, no income tax, no depreciation. Power of NOI. Like I said, this is the most important thing that we're trying to do. The goal of all business plans in multifamily is to increase NOI. So no matter what your plan is, if it's a value add, if it's we're going to raise rents, we're going to manage better, we're going to increase occupancy, we're going to cut expenses, we're going to get a new insurance policy, we're going to do better. Everybody is trying to increase the NOI on the property. All business plans are trying to increase NOI. They're trying to increase the income and decrease the expenses if they can. When you increase NOI, you increase the value of the property. This is called forced appreciation. So that's the difference. Now, when we talk about NOI and decreasing expenses, I just kind of want to go on a little bit of a tangent there. It is very, very difficult to decrease expenses on a property. So if you are looking at a property and you find a way and you're underwriting a property and you're an operator and you're finding a way to decrease the expenses, maybe they have too many people on staff. Maybe people are being overpaid. Maybe the property management company is being paid too much. They're being paid 5% when you can get 3%. Maybe the insurance policy, you can get a new policy and you can reduce expenses. A good operator, a good underwriter will show the expenses as level for the next year, and they won't take that into account. Because when you get into a deal, it's very hard to reduce expenses. It always seems like they either go up or they stay kind of the same. And if you can hold down expenses to the same as the year before, you're doing really well. So when you look at deals, if they say they're going to cut expenses dramatically, I would be very cautious on that deal because I don't think it's realistic, not just from what I've seen. So forced appreciation, we're increasing the NOI, we're making the property value go up. This is why you can have a apartment complex on the same street as another apartment complex. They could be the same number of units. So hypothetically, let's say there's 100 unit on Main Street, and down the road, the developer built another 100 unit and they're half a mile apart and they're the same complex. And one has an NOI of 400,000 and one has an NOI of 600,000. Same building, same design. The one that has an NOI of 600,000 is going to be worth 50% more than the property with 400,000. So when we value properties in commercial, we're valuing it like a business. The NOI is king. When you increase NOI, you increase the value of the property. And that's what forced appreciation is. Now, in residential, that's not the way it works. So let's say you own rental properties, and let's say you raise your rents $200 a month because you buy a property and they were below rent. Let's say you're able to do a rehab on the property and it looks a lot better and you can raise rents. Let's say you protest your property taxes and you're able to get the taxes down. So you decrease your expenses. Let's say you get a good deal on insurance. So you do all this work, and basically on a residential property, you're going to put more cash in your pocket if you raise rents. But on a residential, a single family or a 1 to 4, your property is worth what a realtor in your neighborhood could sell the property for. And what you're collecting in rent does not make any difference on that. If you are a good operator, you're increasing rents, you're controlling costs, you're operating well, you're keeping the properties full, you're keeping tenants paying, you're going to be rewarded with that cash flow. But it's not going to change the value of the property. So in multifamily or in any kind of commercial, NOI up, property value is generally up. Now, I'm going to make one note, and we're going to talk about this circumstance because it's very relevant to what's going on now. Forced appreciation may not occur if market conditions deteriorate during the hold period. Okay, so what happens? We buy an apartment complex and we increase the NOI 20%. And the value of the market, which is going to be cap rates, we're going to talk about that in just a minute, the property value goes down 20%. Well, what happened is when the market changes like that, you might be even. So you got NOI up 20%, market down 20%, and they're a push and they cancel each other out. So forced appreciation works when the market is constant or if the market gets better. So we went through a period from 2000 and probably like 11, maybe 10 or 11, all the way to 2022, where interest rates were going down. The market was getting better. There were tailwinds, and this was helping the values on every property. Then interest rates went up, and it disrupted that, and conditions deteriorated. And that affected a lot of values. Now, I'm going to show you a way later in this how to avoid getting caught in this type of trap. And there's a lot of people that got caught up in this. They were looking at basically the previous returns on investment, on deals. Those like people were hitting home runs, people were throwing money in, and the operators stopped being careful because they'd always had a good market, and some investors weren't being as careful and they didn't know. And it's a little bit easy to look back at things that went wrong and be judgmental. I'm not judging any of the operators. They were doing the best they thought they could at the time. In the market, that was the information the market had given them. Anyone that got in the market the last 10 years had never been through a disruption if they came through the financial crisis. So that's what happens. So we're going to talk about that. We're also going to talk about how to protect yourself from those kind of downturns, because if you underwrite and invest correctly, you're going to be affected by that, but it's not going to be as much as people think. And we'll cover that in a later slide. Cash flow. Cash flow. Everyone talks about cash flow. Everybody wears the hats with the cash flow on the top, the Grant Cardone hats. What is cash flow? Okay. All cash flow is, it's what remains after you subtract the annual debt payments from the NOI. So the formula here is NOI minus debt payments equals cash flow. Okay. If you don't have any debt, let's say you own a property free and clear, and I know people that do. I know one person that has a property for their family, and they're very successful. They're a syndicator. They got one that they keep for their family, and it's paid off, and there's no debt on it all. And it's kind of like a cash cow for them. That it's like it's always going to be there. They don't have to worry about debt. They're managing it very well, but they also do other deals. So if there's no debt payments, NOI equals cash flow. If not, your NOI is $500,000. We got debt payments of $200,000, and our cash flow is $300,000. So that's the formula for cash flow. And annual debt payments are always principal plus interest times 12. If the debt has an escrow account, we don't include the taxes and insurance. Remember, taxes and insurance are expenses that are in the NOI. So if you take the NOI and you subtract an escrowed account with taxes and insurance, your cash flow is going to be wrong. In fact, it's going to be nothing probably because you're counting taxes and insurance twice. So beware of that. So debt payments are always principal and interest. Taxes and insurance are part of the NOI. Debt service coverage ratio. This is a metric that measures the available cash flow to pay debt payments. This is one of the most, if not the most, important metrics to look at the safety of the investment. And this is something that is not looked at very carefully. Very few people put their DSCR when they're going and doing and marketing a property, trying to get investors, but it's extremely important. So it's a ratio of cash flow to debt payments. The formula is debt service coverage ratio, or DSCR, equals NOI divided by annual debt payments. So if I get an NOI of $600,000 a year, my annual debt payments are $300,000 a year. Get your calculators. 600,000 divided by 300,000 is 2. So it means I'm getting twice as much NOI, cash flow, and I'm basically the annual debt payments are half of that. So in this case, it's a 2. Okay, so we're looking at that ratio. So what does that mean? Okay, so a higher number signifies a higher cash flow. So anything more than one. If you have more than one, you have positive cash flow. The closer you are to one, the closer you are to break even. If you go up to a two, which is fairly common in multifamily, it means you're bringing in twice as much cash flow or twice as much NOI as you are the annual debt service. So that ratio, if it's a two, would be very good. It'd be excellent. If you're equal, that's break even. So if you buy a deal that doesn't have a lot of cash flow, something goes wrong, rents go down, you lose tenants, you get under one, that means the NOI is equal to the annual debt payments. This is when you start running into trouble, it's break even. Sometimes you'll see on a deal, if you're underwriting, they'll have the break even occupancy point, which is really important. So we're 95% occupied. Our break even occupancy is 70. And that means that basically they could fall down to 70% occupancy and still break even on the cash flow and make the debt payment. If you are less than one, you have a negative cash flow. So you're not going to be able to get a loan that's less than one unless it's some type of bridge debt or a bridge loan. Even a one would not work. Normally with Fannie Mae or Freddie Mac or any kind of bank loan, the minimum is going to be about a 1.25 or 1.3. So you're going to get about 25 to 30% more NOI than what the annual debt payments are. And you'd have to have a good operator and a good business plan. So DSCR, always look at that. If the DSCR is one, that means they're getting some type of debt, basically that doesn't require positive cash flow. This is a deal to stay away from. If it's negative, they're not cash flowing. I'm going to really emphasize in this course, don't buy deals that don't cash flow day one, and we'll talk about that. But if it's more than one, it's positive. 1.25, 1.3 is kind of on the margins. You get to 1.5 to 2, that's really good. If you get over 2, then we'll talk about that. You might want to be borrowing more money. It might be too much. You might want to have a little bit more debt. So cash on cash return, this is very important. The way to look at cash on cash is it looks at your distributions, the money being paid back. It does not take into account the exit or the sale, the money from that. So it's really the money being paid distributions. And it's a measure of income earned on the cash invested in a multifamily real estate deal or any type of deal, basically. But here we're talking about multifamily. The formula as a percentage is annual cash flow divided by cash invested. So if we get $8,000 in distributions, or that's scheduled for, say, the second year, the annual cash flow, $8,000 divided by, if we put $100,000 on the deal, is 8%. So if you take 8,000 divided by 100,000, it's going to say 0.08, which is a percentage on your calculator, and that's going to be your cash on cash. And cash on cash is really important because what it tells you is the deal paying me to wait? More cash flow is better, more cash on cash is better, but you should have money that's coming in, that's being paid on distributions, and it's paying you to wait until you can do an exit where you may have a big payday there. Also, having good cash on cash will save you if something goes wrong. We'll talk about that in a later slide. So average cash on cash is usually the average for the whole hold period. So if you have a 5-year business plan, you'll see like when in marketing, average COC or average cash on cash is 7%. They are basically advertising what the cash on cash should be over the whole hold period. Now, remember, cash on cash does not include the exit. So I was talking to someone one time about this, and we're going over a deal, and we had a cash on cash of like 7.5%. And I remember, going over that, and they said, "Well, that doesn't sound that good." And I said, "Okay, compared to what?" And there was just silence like that, because really in commercial real estate or multifamily, the cash on cash is generally better than anything else you can get on other type of traditional investments. So if you're investing in the stock market, dividends, your cash on cash is like less than 2%. If you're investing in bonds right now, a muni bond's 4% tax-free. A 30-year treasury might be 5%, but they're taxable. normally on these distributions, we're using every a lever in the book to provide these distributions tax-free. So you're being paid money and it's cash flow you can live off of while you're waiting the exit. So remember on cash, if you see 7 or 8%, it's not that bad, because remember, if the business plan is being executed, we're going to try to double your money in 5 years. So you're being paid to wait, and you can use that cash flow, and it's more money than you can get in a stock, a bond, a savings account, a CD, anything like that in most deals if they're being run properly. So keep that in mind. Equity multiple. This is one of the most important. And the thing about equity multiple, the key to it is it's used to evaluate the total profit potential over the life of the investment. Equity multiple includes the sale. Okay. Now, equity multiple does not take into account the time of the investment or the time of the business plan. Okay. So if you have an equity multiple of 2, okay, and we achieve an equity multiple of 2 within 3 years, we doubled your money in 3 years. That is incredible. That's awesome. Most business plans in multifamily are going to be 5 years, and you're going to want to see an equity multiple of around 2. Okay. One thing to be cautious on: sometimes you'll see an equity multiple and they'll say like 4 to 7. I'm in a fund right now that's 4 to 7. But the fund is a 10-year business plan. So, I mean, if it's a 4, you could double in 5 and then double again, and you're at a 4x, and then maybe a little bit more. So when you're talking about equity multiple, remember, it doesn't take into account the length of time to get that equity multiple, okay? But it should have a definitive thing in the business plan. So equity multiple by itself, if you don't know the life of the investment, it's not as valuable. But with equity multiple, you need to understand that. So equity multiple, the calculation is total cash return divided by total cash invested. Very, very easy. So if you do a deal and you put $100,000 in the deal, and with all the distributions and the sale and all the money on the deal, they returned you $200,000, that'd be an equity multiple of 2. Total cash return, 200,000 divided by total cash invested, 100,000. Once again, always includes the sale or the exit, which is different than cash on cash, which doesn't. We're looking for a multiple of 2 or better on multifamily deals. If the equity multiple is under 2, it's not as good of a deal. Now, I will see sometimes people will sneak in a smaller equity multiple, but they'll say, hey, we only have a business plan for 4 years, so it's okay, or it's 3 years. I mean, sometimes you have an equity multiple and it's development, and they have a 3-year business plan. So the equity multiple is like 1.6, 1.7, which wouldn't be bad for 3 years. But if something goes wrong, the project gets delayed, your returns are not going to be that good. So we're looking for an equity multiple of 2 or better, including the sale. We're looking at doing doubles. Most operators, if you ask them about when they want to sell, they will tell you if they have an opportunity to double people's money, they will usually start considering a sale at that point. And a lot of your early exits that look really good, 3 years, 3.5 years, sometimes less than 3, but 3 years, it's because their business plan called for an equity multiple of 2 or a little bit better, and they achieved that within 3 years because everything went well. The business plan went well, and the market was great. They're able to double people's money, and they said, hey, let's take this thing out now. Let's double people's money, and then let's go buy another deal. So looking for an equity multiple 2. This is a doubles game in multifamily, and when they have a double, they look at exiting. Internal rate of return. I'm putting these basically in order of importance, and it's reverse. So the things that are higher up, I think, are more important. Internal rate of return. So let me give you some definitions on this. It's the annual rate of growth that an investment is expected to generate. Okay, that's like the simplest definition I can give you. It is the annual return with the cash flow, with the distributions, and then with an exit. And it takes into account the time value of money also. So let me give you another definition here that's a little more technical. IRR is a discount rate that makes the net present value of all cash flows from a particular investment equal 0. Okay, you're probably getting a little more confused now. That's okay, just bear with me. It represents the annualized compound rate of return on an investment, meaning it's the interest rate at which the investment's future cash flows would exactly offset the initial investment. And let me give you one more here. It's typically found through trial and error or by using a spreadsheet software like Excel. There isn't a straightforward algebraic formula to solve for it directly. However, the underlying principle is zero equals whatever that symbol is, parentheses, cash flow, time, divided by 1 plus IRR, upscore T, parentheses. Okay, so I'm having a little bit of fun here, but I'm actually kind of trying to intentionally confuse you a little bit. So the reason for this is don't ask an operator how to calculate IRR. Because if you do, they will sound stupid because unless you're like a PhD in mathematics or you went to college and studied physics or some higher level math, you're not going to be able to figure it out. You can't figure out with a calculator. It is impossible to figure out. The most important thing is it's an annual rate of return. It does take into account when you're getting your money back, your return of your original principal and the cash flow, and getting money back is going to give you a higher IRR. Okay, so if you're getting more cash flow in the beginning and it's increasing quickly and you're getting closer to getting all your money back, you're going to have a higher IRR. If you're exiting earlier, this is what explodes IRR. So if, let's say, an investment has a 16 IRR, and then they get into the business plan and they exit in 3 years, and this was going on a lot before 2022, that IRR of 16 turns into like a 31, or it looks really, really, really impressive. They just got to a double faster. So the way to think of IRR, it's an annualized rate of return, and it takes into account when you're getting your money back and your full investment back. And it is very, very sensitive to time periods. So if you go to a shorter time period, it's going to blow it up. If you're taking longer to get your money back or there's delays, it's going to go down. There's high sensitivity. I like this definition a little bit better. This is from Investopedia. Internal rate of return, IRR, financial metric used to measure the profitability of investment that takes into account the time value of money. Please study this slide. Don't study the previous one. I don't want to intentionally confuse people, but I get asked all the time on how to calculate IRR, and it's impossible. No IRR, it's important. It's an important metric. It's an annual rate of return, takes into account when you get your money back. If you're not getting any distributions on a deal for a few years, like in development, it affects the IRR. Usually those deals look better from an IRR standpoint because it's a 3-year business plan. So keep that in mind when looking at IRR. Okay, cap rate. When I first got in the business, this was very confusing to me. Okay, and I had a lot of difficulty with this, and it took me a while to sort it out. And cap rate is extremely important, but it can be confusing. So we're going to go through it, and I'll give you some ideas that I have to make it a little bit easier to understand, easier to remember. Okay, so capitalization rate, or cap rate, is the metric used to estimate the potential return on investment for an income generating property. Okay, it's calculated by dividing the property's NOI by its current market value. So if we have an NOI of $600,000 and we have a market value of 10 million, so we're looking at a property and the annual NOI is 600,000 and they want to sell it to us for 10 million, we would take 600,000 divided by 10 million and we get 0.06. So it's a percentage. So cap rate is a percentage, but when people are talking about cap rate, they take the percentage out. So in this case, they would say the cap rate is 6. They take the percentage out. Also, you'll hear people say that's a 6 cap. People that are in the business trying to sound cool. Okay, so it's often referred as it's 6 cap, it's a 7 cap. All that means is the capitalization rate is 6. So the formula, once again, net operating income divided by property value times 100 to take the percentage out, and that's going to give you your value. 600,000 in this example divided by $10 million, and you're going to get 0.06 times 100, you get 6, cap rate is 6. Another way to look at it is basically it's the percentage return if you paid cash for the property and didn't have any debt. So in this case, if I had a lot of money and I said, I'm going to go pay cash for a property, this $10 million property, and it's going to deliver a 6% return because it's got $600,000 of NOI. That's another way of looking at it. So it'd be the return without any debt as a percentage. So hope that's not too confusing. I had early on, I couldn't figure out how cap rate was good, and higher was better and lower was worse. Obviously, it depends on the situation. It basically, it was very difficult for me to figure out. But in general, higher is better, but it also depends on the property type and the market. Higher just means the property's less expensive. If you're buying a $10 million property and you're getting a $600,000 NOI, your cap rate is 6. Really, really, really good. That's fine. If the cap rate is 4, it means if you paid cash, you'll get a 4% return on the investment. Okay. That means the property is very expensive and you're not getting a very good return. So that's the way to think about it is what kind of return am I getting in cap rate? Now, why are cap rates important? The market cap rate and property values, this is where cap rate starts becoming important. Okay, to avoid overpaying for a property, you've got to research the market cap rate. This is something the operator is not supposed to, should be doing. They're going to be doing, not you. But if you can kind of figure out what the cap rate is in a certain market, then that's going to be really important to make sure you're not overpaying. Okay, so basically the current value is the NOI divided by the market cap rate equals the current value. Here's where it gets kind of interesting. Okay, so let's look at NOI, and we've got basically the NOI going up. So let's say in this case, it goes up 20%. It goes from 500,000 to 600,000, up 100,000. That's a 20% change. But then the market cap rate goes down 20%. Okay, so it goes from a 5 to what would it be, like a 6.25. If that happens, basically the NOI increased and the value did not increase. It stayed the same. This has happened quite a bit to deals. And there's been deals where actually the value went down quite a bit and they weren't able to raise the NOI. So that becomes a huge problem where the cap rate affects the property value. And if it changes over time, that's where you get difference in property value. And that can also go the other way. So like right now, cap rates are pretty high compared to where a few years ago. Cap rates start going back down. You get forced appreciation. You raise the NOI 30%. The property goes up 30% from that. And then maybe it goes up 20 or 30%, just getting back to what the norm was in 2022. So you might have some serious tailwinds. So we'll talk a little bit in a second about the values, NOI, and market cap rate, but that's basically how you figure the current value. And if you're increasing the NOI and the market cap rate is changing, then you got a problem basically. Okay, cap rate and debt structure. This is super important to understand that you can buy at different cap rates in different times, and you can always get basically a pretty good deal. Okay, so interest rate less than cap rate equals positive leverage. Okay, so how does this work? So let's say right now you can borrow money in the low 5s. Okay, I'm going to call it a 5 right now. It's not exactly 5%. It's low 5s, and the cap rate is 6. Okay, so remember we are looking at our NOI. Okay, we're looking at the property value. The cap rate is 6, so it's returning a 6% return, taking out with no debt. And now we can go out and we can borrow debt at 5%, and we can buy something that's cash flowing 6%. Okay, so that spread when the interest rate is less than the cap rate, that's called positive leverage. And you want positive leverage on every deal. Okay, so positive leverage is when deals start looking really good. The bigger spread there is, It's 100 basis points or more, deals start looking really good. When deals get compressed down and there's no positive leverage, they quit looking as good, and negative leverage starts looking really bad. So if you have the debt rate equaling the cap rate, the leverage is even. So that means the leverage equals the cash flow it's buying. So in this case, let's say we're buying a cap rate of 5 and we're borrowing debt at 5. We're not getting anything for the money we're borrowing. We're basically just able to buy the property and put less money down. Maybe we're putting 30% down, but the 70% we're financing, we're not buying anything other than putting less money down. So I hope that makes sense. Now, sometimes if you're in a good market and you're buying a brand new property and it's an A-class property, I mean, they're lower cap rates and the debt and the cap rate are going to be very close. And you might even get a negative leverage. We'll do that in a minute. And on A-class property, sometimes you have to do that. But I think you've got to be very, very careful when you get into even type of leverage, because it means you're really going out and you're borrowing money to buy lower cash flows. I think you should always go for positive leverage, or maybe on new construction, maybe closer to even, and thinking you're going to own the property a very long time and you're going to have a long life cycle of the property. Interest rate is greater than the cap rate. This is negative leverage. This is not good. This means basically you've got let's say you have a cap rate of 6, you're going out and borrowing money at 7. And so instead of saying the cash flow to your pocket or your investors, you're saying it to the bank because your interest rate is higher than your cap rate. So when you look at these deals, you need to find out what the cap rate is, what the market cap rate is, and then is the debt we're getting, is it significantly less, hopefully 100 basis points or more, where we're getting some positive leverage? Are we borrowing money to buy cash flow, or are we borrowing money just to even it out, or are we borrowing money and then we're sending it to the bank because the cash flow is not going to cover what we're borrowing? Okay, very important. Not many people talk about positive and negative leverage in these deals. It's extremely important to understand this and to buy deals with positive leverage. Okay, market cap rates change as rates change. They tend to move in the same direction. Okay, so how does this work? Okay, so let's go back to 2021. And let's go to like a hot market like Miami, Florida. Okay, I'm just going to go to hot markets. Back then, you could borrow money, Fannie Mae, like 3%. I mean, some of you guys probably have a home mortgage that's at 3%. It's awesome. But you could borrow multifamily at 3%. And at some hot markets, basically, you were able to buy like in Florida, 3.5, 4 caps for newer construction. If it was like in a Miami or one of these really, really super hot markets. So people were buying it because the deals would pencil out. Yeah, we're buying a 4 cap, didn't make a lot of sense, but we can borrow the money at 3%. We get a lot of positive leverage. The numbers look good. It's cash flowing good. It looks good. Those deals are kind of in trouble now. And the reason why is they were so expensive that as the interest rates started going up, so let's say the interest rates go to 4%, well, stuff that's a 4 cap stops penciling. It just kind of becomes even leverage. It doesn't make a lot of sense anymore. People, I'm not going to buy this. The property sits on the market and they've got to sell it for a higher price. They're selling it for a 4.5 cap, then a 5 cap. Then the rates go up to 5 and you're to 5.5 or 6. So as interest rates go up, it's going to push cap rates up over time. There's a little bit of a lag. And it's because people can't sell their properties at the lower cap rate because the deals don't make sense anymore. If the interest rates on multifamily were like 6%, which they were in 2023, and you're borrowing debt at 6% or more, and you're going out and trying to buy a 4 cap, the deal is not going to make sense. There's no way you can make it make sense. So the prices have to go up. The prices will go up as rates change. If rates basically go down from here, you will see cap rates go down. They will follow that. If rates go up, the cap rates will go up. Hopefully we're at the top of a market cycle, but there is a way to protect yourself basically in these situations. And we'll talk about that, but they're going to tend to move in the same direction. And as rates go up, cap rates are going to go up. And if you buy at a very low cap rate, you buy a hot property, you buy at the top of the market, this can definitely affect your investment. Okay, forced appreciation. We're going to go back for a moment to NOI and talk about forced appreciation. I'm going to give you an example of forced appreciation. So here's how you force appreciation. Okay, we're going to take a very simple example here. And I was sitting at a table at lunch in 2022, and someone showed me this example, and this is what got me into commercial real estate. Okay, this blew my mind. They were on it. It was like a napkin. They're writing it down at lunch. I'm eating a burger, and I'm watching this and going, I gotta get into this business because I've never seen anything like this before. So let's say we have a 100-unit apartment complex. Okay, make it real simple, and we're 100% occupied, and we can raise the rents $100 a month on everybody in the complex because the market is quite a bit higher. Or let's say we just bought it and the market is $100 higher. So we took 100 units, we did $100 a month more in rents. Remember, there's 12 months. We multiplied by 12, 100 times 100 times 12, okay, equals $120,000 in extra NOI. Let's assume that our expenses were constant. We didn't change expenses. Insurance and taxes didn't go up. We didn't have more maintenance. We just raised everything $100 a month. And this was very, it hit home to me because I remember being in an apartment complex and my rent raised more than $100 one year. And I know you can definitely do this. We definitely do this all the time in multifamily and stuff's below market. So 100 times 100, $120 NOI. And let's say our market cap rate is 6%, and that's about most properties right now. So we take $120,000 in NOI, we divide 120,000 divided by 0.06, and you're going to get a change in property value of $2 million. Okay. So when I saw this the first time, this really blew my mind. And I was like, oh my goodness. So just raising $100 a month, the property's worth $2 million more. Yes. That's how it works. That's how we make money. Raising a rent or cutting expense, increasing NOI, $120,000 NOI in a 6-cap market is a $2 million difference in the property value. This is a very simple example, but the reason I want to show you this is $1 of NOI makes a $16.66 difference in increased value in this example. And on a 6-cap, that's the formula. So great operators are going in these complexes and they're just trying to raise the rents $20 or $30 on renewals. They're going in the office and saying, hey, you guys have a TV over here and the cable bill is $100 a month and we can get it down to $70. Every dollar you can save or you can earn, a dollar saved is not a dollar earned. A dollar saved or a dollar earned is $16 of increased value. And if you're looking at a 5-cap market, it would be 20. So every time you save a dollar, it's like putting a $20 bill back in the property and the value or in the investment. So this is very powerful. This is the real leverage of multifamily. And this is something you can't do in residential real estate. So let's take the other example. Let's say I had a single family and I raised rents $100 a month for 12 months. So I put $1,200 in my pocket, which is awesome. I mean, it'd be great to have the money and go do some nice things with $1,200. It would definitely improve your life, but the value of the property would not change 1 cent. Okay. Now you say, well, I've got more than one single family. Okay, fantastic. Let's say you have 100 single families and you raise rent by $100 a month and you drive 12 months. And if you could pull that off with 100 single families, you're awesome. And you would put $120,000 in your pocket. It's not bad. Not bad at all. That's a pretty good yearly increase in your income. However, your property values would have changed exactly zero. They are still worth what a realtor can sell a property for in your neighborhood. That's what forced appreciation is. That's the difference between single family and multifamily. I'm not saying if you have single families, go sell them all and put it in a multifamily. I'm just saying the metrics on multifamily are different. And if you like single families, you should definitely own both because what we do with NOI and forced depreciation is not something you can do on a single family property. Okay, let's roll all this together into what it looks like when you're looking at a multifamily deal as an investor. And this screen is an actual shot from an actual deal with actual numbers on a deal that I've done. And this has all these metrics on one page. And it's like we call it a tear sheet for an $100,000 investor, what it looks like. So I'm going to go through some of these terms and see if you can follow me, and we'll see how well you absorb this lesson. So $100,000 investor, their LP IRR is calculated at 16.6%, 16.16%. So they should be earning 16.16% annually. And this is a 5-year hold. Their limited partner equity multiple, it's abbreviated here, obviously, is a 2.01. So we get a 16% return. We've got a 2.01 equity multiple. They're putting $100,000 in. The cash on cash year one's pretty low. It's about what a CD is. 4.17. They're taking over the property, getting everything sorted out. This is a very conservative deal, by the way. Year two, 5.56. It's going up. The cash on cash. Year three, 7.04. Year four, 8.06. Year five, 8.69. So it's getting pretty good. So you add all those things up and do an average, and the average cash on cash in this deal is 6.71. So I'm just giving you something with kind of all the numbers you can look at. $100,000. They did cash flow from operations of $33,525. Capital event cash flow. Anytime you hear capital event, that word, it means sale generally. It could mean refinance. It means anytime you're giving a bunch of money back to people. If you do a refinance and give people their money back, it's a capital event. If you're doing a sale, that is the primary capital event. So in this case, $100,000, cash flow, $33,525, capital event, sale, cash flow, $167,649. Our net cash flow is $101,000, and you start out getting 100. So we doubled everyone's money in this example. And this is kind of tying together what all those terms, what all the numbers look like on a real deal. I want to kind of show you an example. And this could be kind of overwhelming, but basically this is what it looks like. You've got your IRR, you got your equity multiple, you have your cash on cash, you have your average cash on cash, you have a 5-year business plan. This is what returns like in the real world look like, just to give you an idea. So normal range for metrics in the market, and this is as of 2025 right now. So cap rates, okay, it needs to be above the fixed interest rate. So markets are going to be different. Market cap rates are different. The different, cap rates in Dallas or Austin are lower than they are in Houston. They're lower in Florida than they are in most parts of Texas. They're actually quite a bit higher in the Midwest, okay? But you need to have a cap rate that's above the fixed interest rate. You need to have positive leverage. You need to figure out the market, what's a good deal, and then make sure that that cap rate is above what they're borrowing the money for. Okay, IRR, I would say right now, you should look at 15 to 20% with fixed rate debt, okay? Can people do better IRRs? 100% they can. But right now, if you're getting fixed rate debt and you're promising investors more than 20%, you might be overpromising, or you might have an operator that's overly optimistic. And great operators are kind of like poker players. I mean, if they think they have a 25 IRR in hand, they're probably going to underwrite it super conservative and show an 18 or 19. So they can really blow people away with what a great job they do and get a lot of business and a lot of referrals from it. So if they're promising more than 20, just be careful. I'm not saying the deal is dangerous. I'm just saying that they may be over optimistic or maybe trying to attract capital, showing a high IRR. So be careful. So I usually look at 15 to 20 as kind of a reasonable range with fixed rate debt. We'll talk about that in a minute. Equity multiple. Low twos on a 5-year business plan. And we're talking about existing multifamily, not development. Development's a whole nother world. I'm not really covering development in the series. I'm assuming we're buying projects that are existing projects. Right now, those are on sale. Development has different risk, and I would just go where the things are on sale right now. Equity multiple, low two, a two is great. Low twos are fine. If you start getting above a 2.5 or 3 on multifamily on a 5-year plan, I just, I don't know if they're going to perform that well. And once again, the operator may be optimistic. They may be overly confident on their ability, or they may be throwing some huge numbers out there just to attract people that are swinging for home runs. So be a little careful when the returns look too good to be true, because sometimes they can be too good to be true. Okay, and DSCR, and this is one of the most important things to look at, like right away on fixed rate debt, debt service coverage ratio. What DSCR tells you is the deal cash flow immediately. And a 1.3 is kind of the minimum right now to get a bank loan approved. So that would be a low range right there. Up to around a 2 is great. That means you're bringing in twice as much NOI or cash flow as what the debt payment is. That is a fantastic marker there to be at a 2. Probably 1.5, 1.6, 1.7 is kind of a sweet point. If the DSCR is greater than 2, is the leverage too low? So if you're getting twice as much cash flow as what the mortgage payments are, could you go out and borrow more money possibly to make the returns a little bit better if you have positive leverage? So that's something to keep in consideration when you're looking at it. Over 2, maybe they should go out and get more debt. Okay, so key points for investors. As investors, this is the important things to keep in mind. This is what you should learn from this, or your takeaways. Number 1, get fixed rate debt, lock in positive leverage. Okay, right now, I'm not recommending doing anything with variable rate or bridge debt, period. Not every deal that gets variable rate or bridge debt gets in trouble, but it seems like every deal that's in trouble has variable rate or bridge debt. So if you get fixed rate debt and you lock in positive leverage, that's going to make your deal go a lot better. So we're buying a 6.5 cap. We can borrow at a 5.5 cap. And then what happens is we increase cash flow, the cap rate actually goes up, but the debt payment stays exactly the same. So the deal gets better. It's going to cash flow better. It's a lower risk environment. And if you're getting fixed rate debt for 7 or 10 years, you're dramatically decreasing your risk on the property. So get fixed rate debt, make sure you're locking in positive leverage. I'd be really careful about going in and buying a 5 cap, and then basically the leverage you're borrowing at a 5, you're not getting any positive leverage. Another thing about development that can be really scary is you're going to sell the property 3 years from now in the development when it's breaking dirt to being fully stabilized and leased up. We don't know what the market's going to be in 3 years. We only know what the market's going to be now. So get fixed rate debt, get the positive leverage, and lock in the positive leverage. Now, the problem with getting variable rate debt is a lot of people say, well, we're buying at a 6.5 cap, we can borrow at a 5, and rates should go down. Well, if rates do go down, you'll get more positive leverage. That's great. But if rates start going up and the rate's not locked, your positive leverage becomes even leverage. And then as it goes up and goes out of control, it could be negative. And I know people can get rate caps. There's all kinds of tricks. There's all kinds of insurance, but rate caps can expire. Things can go wrong. Banks have more control and bridge debt about calling in loans. There's just all kinds of problems right now. If you're a beginning investor and you're not super rich and you don't have money that you're willing to lose to get a little bit better return, I would just go with fixed rate debt and sleep well at night, but make sure you're locking in that positive leverage. Don't buy deals that don't cash flow day one. So we're looking at the DSCR 1.3, 1.5. If you're getting an initial DSCR of 1.5, what that means is the deal is going to cash flow day one. Okay. 1.5 means we're bringing in 50% more NOI than what it takes to cause the debt payment, to pay the debt payment. So buy deals at cash flow day one. If the property is in bad shape and there's going to be no distributions for 2 years, it's not going to cash flow for 2 years, I would steer clear of that deal. I would stay away from that deal. I think it's a lot more risky, a lot more dangerous. Get fixed rate debt, buy deals of cash flow, positive DSCR 1.3 to probably 2. Always buy for cash flow, not appreciation. Okay. If a deal has problems, it may not cash flow as well as planned, but cash flow will save you. And if a deal is cash flowing well and the market is bad and you get 7 or 10-year debt, you can wait until the market gets better. Don't ever buy a property because you think it's going to go up in value. So I'm going to give an example here. This is not a real world example. It's a hypothetical. But let's say you went out and bought a property and you buy a property and you get fixed rate debt. And let's say the average cash on cash is 8% over the 5 years. So let's say the operator's really good and they perform an 8% cash on cash. So they promise an 8% cash on cash. They performed an 8% cash on cash. And let's say they said, look, we are going to use 30% down on this property. We're going to increase the NOI by 30%. And so we're going to double everyone's money. Okay, that's a very typical business plan. Sounds good. During the 5 years, and let's say they have a 5-year loan and they had to sell after 5 years. And so they got into the loan coming. They had to sell 5 years. They bought at the worst time, the top of the market. A recession happened, a financial crisis happened, a multifamily meltdown happened, or whatever happened. But instead of the property going up 30%, the cap rates expanded and the property did not go up in value at all. Okay, so let's say they bought it for $20 million and they're like, this property is going to go up to 27, 28 million, but everything went wrong on the deal and the property only stayed at the $20 million they originally purchased. Okay, so what happened on the exit? You got your 8% cash on cash. They were great operators. You earned 8% on your investment. You didn't pay any taxes on the 8%. So really, to me, it's like a taxable equivalent of like 12, a third coming out for taxes. And at the end of the 5 years, they gave your principal back. Okay. In real estate, this would definitely be a single. Would it be a disaster? Would it be a tragedy? No. I mean, it wouldn't be a great deal. It's certainly anything to brag about. The operator would be like, wow, this wasn't really that great of a deal, but you get your money back. So what I'm trying to show you is if you lock in positive leverage and cash flow and you have a cash on cash that's good, if the property doesn't even go up in value, you're still going to be okay. The whole idea is not to lose money, not to lose your principal, not to get in deals where go haywire, and they're basically there has to be appreciation, either so they can sell or so they can refinance. It's not dependent on the capital event. And if you have 7 or 10-year debt, if you have something that goes wrong or a recession or a financial crisis or whatever happens, a natural disaster, you have 7 or 10 years. So you've got 2 or 3 or maybe 5 years extra on that business plan to execute. So buy for cash flow, buy deals at cash flow immediately, lock in positive leverage, get fixed rate debt. If something goes wrong, they can, even if the market changes, if they're getting NOI to go up, they're probably going to be able to sell the property 5 years later for at least what they bought it for, and they can scrape out of the deal. And it's not a great situation, but it's better. Here's where things really go wrong. Deal's not cash flowing day one, and they can't get a regular bank loan or a Fannie Mae loan, so they're going out and buying bridge. The property's not cash flowing. Taxes and insurance go up. Interest rates go up. Their rate lock expires. The negative cash flow gets worse, and they run out of money, and there's a foreclosure, and you lose all your money. That is not the kind of deal you want to be in. So be a little more conservative. I think in real estate, if you can learn how to not lose money, you'll be one of the most successful real estate investors of all time. That is what is really important.